It's puzzling that society has such confidence in the value of central bank fiat currencies, yet so little belief in Bitcoin value. Granted, there are several factors that play into this line of thought, but a general lack of financial literacy is most likely the largest factor. This begs the question, can strong confidence in the value of fiat currencies versus Bitcoin be the result of fewer incentives to save, accumulate wealth, and invest in one's financial literacy? To try and answer that question, let's compare the properties of fiat currency, Bitcoin, and gold to determine if Bitcoin has become a viable option for a diverse portfolio. Bitcoin value comparison. There are two major purposes of money. One, store of value. Two, medium of exchange. Currencies that are a good store of value usually make poor mediums of exchange. Good mediums of exchange are used globally but are questionable as stores of value. How a currency scores as a store of value versus medium of exchange impacts its usefulness as a unit of account and standard of deferred payment. Store of value properties. Fiat currency supply increases at the whim of the Federal Reserve, and there's nothing scarce about it when politicians can will more of it into existence. Bitcoin's mining supply grew at an infinite pace in 2009 when the currency came into existence, but has slowed, and sometime around 2140, the last new Bitcoin will ever be mined. The Bitcoin market anticipates this, hence the extraordinary bull market in the digital currency. This contrasts with gold, whose price has been depressed by 94 million new ounces coming into the market each year. Gold is limited, divisible, counterfeit resistant, and virtually indestructible by nature, whereas Bitcoin has all of those same properties and is also democratic, but by design. People who say Bitcoin is not a good store of value really would be more accurate to say it isn't being adopted yet. Stable value. As with any commodity, physical gold and Bitcoin are subject to drastic price fluctuations. Market pressures drove the gold price to historic highs between 2011 and 2013, exceeding $1,900 an ounce in September 2011. So gold prices have responded to supply and demand. Gold is held in most portfolios as insurance because the value is generally stable most of the time and can serve as a specific purpose as needed. You buy it, hold it, and the value changes very little. Bitcoin, on the other hand, has large rises in price that can be highly profitable depending on the price at which it was acquired. By the same token, the price of Bitcoin has fallen more than 10% in a single day dozens of times during the years it has been actively traded. Medium of exchange. Gold is most certainly money and has been used as a medium of exchange and a store of value for millennia. Fiat currency is anything but scarce and is issued by a central bank with the main purpose of being a medium of exchange. But this is not the primary function of money. It should also be a store of value. In order to have value, there must be those who want Bitcoins and want to store them. Gold and Bitcoin offer individuals options with controlled and predictable supply increases. Using Bitcoin as a medium of exchange means individuals don't have to wait for funds to be converted from one currency to another, and therefore no money is lost to conversion fees. If Bitcoin is considered digital gold, then Bitcoin as a global currency would be a move back toward the gold standard, a digital one. Financially, it makes sense to add a small number of crypto assets to your portfolio and rebalance regularly to improve risk-adjusted returns. Bitcoin has combined high returns with low correlations to other asset classes, making for a good combination in portfolio construction. Bitcoin has the required properties to become a reserve currency, and the more the world comes to understand this, the more stable it will become. If you'd like to learn more about investing in cryptocurrencies, then visit our site today. If you enjoyed this video, don't forget to like, comment, and subscribe.